Today and tomorrow, in a cozy setting, we'll talk about the topic, how businesses grew from 1 million to 10 million. And in general, at UCOM, many people believe that a turnover of 1 million cannot even be called a business yet. It is just a marketing project. But in reality, of course, that's not the case. In any case, it's a lot of work, a lot of knowledge, a lot of everything. So this is also a business. But when we talk about growth, there are certain stages you need to be able to go through. And today we'll talk about that. Why can I even talk about this? Why should you trust me? My name is Nikolai. I am 13 Finance. For the past 3 years, I have been the CEO and founder of Jungle Finance, helping various e-commerce businesses. But before that, I worked in the corporate world, including at Printify, which is a Latvian unicorn. And this company was a platform for dropshippers. As a merchant, you needed to create a product. There were 550 different types of products, from t-shirts to candles. Create your own design, list them on Shopify, Etsy, WooCommerce, and so on, and then handle the marketing. After that, the company itself would find a factory, handle the product manufacturing and shipping. It would also take care of logistics, delivery, calculate all the taxes and everything else. And while working there, I also analyzed how our clients were performing. So our client was exactly the merchant, essentially a small business. That was our client. I noticed two such rules. The first is how easy it is to reach 100,000 in annual turnover. It's actually quite realistic. You don't even have to be an entrepreneur. You just need to follow the instructions, and there's a 99% chance you'll succeed. And how difficult it is afterwards to go from that 100,000 to 1 million to 10 million and so on. But hopefully, I probably can't even judge, because the companies that go further, they leave the platform since they want to have a higher margin and start doing more on their own. They start working directly with factories and even buying inventory themselves, not as drop shippers anymore, but as full-fledged sellers, so to speak. But in general, all the rights that I noticed, and not just websites, and then I deal with the financial side. By accepting them, I start applying them in my work, helping other businesses grow. In other words, we are trusted partners. Photo of the file zone. We work there with specific details from various areas of the business, helping to build financial models and increase their overall growth. We create beautiful various dashboards, but our main goal is not to make some kind of product. Our main goal is to have some tangible result. That is, it's either EBITDA growth, margin growth, or an increase in capitalization. And absolutely everything else that we do solely to back up our important strategic decisions with detailed numbers, complex charts, and every other piece of supporting evidence available. So let's get closer to the topic. That is how to grow a business from 1 million to 10, how to scale, how to expand a business. Talking to many entrepreneurs who reach the 1 million turnover mark, that's a really impressive milestone. And even if we move away from e-commerce and look at any other business like driving schools or something similar, business startups, reaching 1 million is hard. That is, it really takes a lot of work. And that means you were able to find a customer and a product, connect them, and make 1 million in sales. That's impressive work. But where, by doing the same things, just say increasing their scale, you still do not always manage to reach the next desired milestone of 10 million in turnover. So if you just start running more ads, launching more products, there's a good chance it won't work. That won't work. What I mean is that maybe your turnover will grow, but it won't affect your business in any way. Your EBITDA, your profit will stay at the same level. And there are even cases when, on the contrary, profit starts to decline. So turnover goes up, but profit goes down. That means that some actions are wrong. And the main difference between 1 million and 10 million is that with 1 million, with all the current platforms, you can still control things simply thanks to the functionality provided by Shopify, Amazon, and so on. We can see our sales, we can see our margins, and so on. But at 10 million, that's no longer enough. At 10 million, you absolutely need to have detailed unit economics. You need to monitor cash flow, have a cash flow forecast, and you need to, and by the way, options for sellable acquisition, that is how to attract new customers as cheaply as possible so that it aligns with our economics. Companies that, well, why doesn't a company reach 10 million? At some point, and there's a rule here as well, many marketers argue with me about this. The more of the market you occupy, the more your cost per acquisition of a new customer increases. Each new customer, as a rule, becomes more expensive. So it's If you now, as we discussed, for example, move from the Ukrainian market to the European market, most likely acquiring a customer there will be more expensive. If you move from the European market to the American market, acquiring a customer there will be even more expensive. And that's just geographic growth. Even if you stay in the same market, let's say you started in America and you're working in America, you got the first 0 to 1% of customers, they were super interested in your product and they came to you relatively cheaply. The next 0.1% of the entire market will be less interested, they'll cost more, and so on. And at some point, when you're already reaching a large turnover, the margins just don't add up anymore. Also, for example, if you used to work only directly with the factory, like in dropshipping, at some point that stops working too. At some point, more and more, there are more returns, other issues arise, and you need to have higher operating expenses, more staff, and all of this needs to be properly managed. This doesn't mean something is wrong, it's normal. When a business grows, expenses grow too, but if those expenses aren't controlled, then at the very least, it's pointless. In other words, your growth doesn't affect you in any way. So the amount you received as dividends at the end of the year or from some conditional source will be the same as before, even if your turnover grows several times. And in the best case, it might even, in fact, this could lead to the bankruptcy of the business. You could end up in a severe cash gap or simply worsen your situation. The business metrics could deteriorate. And there are hundreds of metrics you need to keep an eye on. I think today we'll just talk about the 5 main ones, which probably solve 90% of the problems. The first super important one is cost of provision, that is the cost per client. As I already said, and I'll repeat it, you need to accept that it will keep increasing. If you found some amazing formula, or as venture funds like to say, they ask, what's your magic sauce? Some kind of magic sauce that makes your costs go down, that's great. Don't tell anyone about it, just keep scaling. But overall, when forecasting your business, forecasting cash flow, you need to factor in that it will increase. And you need to look at where we can align this for our journalists. One of the things is average order value, meaning the average order. That is, it means working with the product assortment, working with capsules. You need to look at it. Okay, so now we have a customer. How can we sell to them? How can we sell as much as possible? The second thing, if we jump ahead, is LCV, which is about how to keep the customer with us as long as possible. So we've attracted a customer. Now we need to make sure they come back to us. And also, each of their orders should be relatively high. And on top of that, we need to come up with ways to make them return to us. This could be done either through email marketing to bring them back, or by offering special discounts, or by adding product subscriptions, basically things like that. If at the very beginning we could afford to sell something to a customer and then let them go while we looked for new customers, at a certain point as we grow, we can no longer afford that. We need to make the most effective use of every customer, maximizing their lifetime value. And it's important to keep track of this. That means we should have a separate metric, a dedicated dashboard where we can see how this changes every month. If we already have a team, there should be a specific person responsible solely for LTV, and their bonus should be tied to it. All of this is reflected in the contribution margin. In fact, this is one of the main things we need to monitor, how much we have left, meaning our turnover. After turnover, we pay for production, we pay for delivery, we pay service fees to platforms like Shopify, WooCommerce, and Etsy, and we pay fees to payment solutions like Stripe, eCompare, and so on. And we have some portion left over. We need to compare this portion to our turnover. So if our turnover is growing, the contribution margin should also be growing. It shouldn't be decreasing. Overall, our gross profit should also be increasing. It might grow a bit more slowly, but it should still be increasing. And the payback period is also a super important factor. This is how quickly we recoup the cost of acquiring a customer. So we acquire a customer. How quickly do we break even on them? For example, if just one sale is enough for them, that's really great. But again, it all depends a lot on the business. There are businesses that sell a super expensive product, and in that case, one sale is probably enough. And there are businesses that sell inexpensive products, but they focus on getting the customer to come back. And here, you need to make sure the customer returns frequently. So if we sell a cheap product, but the customer only comes back once a year, well, most likely that's not a scalable business model. And really, everything always depends. There isn't some kind of, how much should the cost per acquisition be, $5 or $500? Both can be correct. It really depends on the industry, the market, and the stage. But there are some golden rules that I'd like to mention. People often ask me what to look at, what the number should be. Just like people ask a doctor for a magic pill, they ask a finance person for a magic metric. The first is LCV over cost per acquisition. That is our lifetime value of a customer, meaning how much we earn from them. It should be 3 times greater than the acquisition cost. I've worked with hundreds of businesses, and if this doesn't work, well, as a rule, I haven't seen a single case where this formula didn't work and the business still grew successfully. So this really has to work. On the other hand, I've seen businesses where, say, this ratio isn't 3 but 10 and everything seems great, but the economics work in such a way that in the end, it still comes back to 3. So roughly speaking, I haven't seen any long-term business models where this number stays at 10 for a long time. It might be a temporary anomaly at some point, but usually it settles around 3, maybe 3.5. The only exception is probably gambling, where due to the high risk, the figures can be higher. The next super important metric is the payback period. This is about when you acquire a user. Here, you always need to look at how the user will pay back, meaning you paid to acquire the user, they came to your platform. Now, very often, user registration happens at the moment of purchase. Previously, there were cases where the user would first register and only then make a purchase, so it was unclear how many days would pass between registration and purchase. And you need to see whether the user can pay off the acquisition cost with their first purchase or if a repeat purchase is needed and how quickly that can happen. But in reality, as practice shows and as finance textbooks say, a user should ideally pay off their acquisition cost in less than 50 days because otherwise your money is tied up. That is, if we're used to thinking of inventory as tying up money, which is generally accepted, then in marketing, it's exactly the same kind of money freeze. So the faster we unfreeze these funds, the better we can scale our business. And yes, the contribution margin, these 2 rules more or less work. LTV over cost of acquisition works for almost all the businesses I've looked at. This rule also works for 95% of businesses. This is very non-specific because I'm in various Telegram channels with finance professionals. And there they often say, if your contribution margin is less than 20%, that's a red flag. It's better not to start such a business. But that's not really the case because there are a lot of low margin businesses that perform well simply because of their large volume. But in general, as a rule, of course, you should try to keep it above 30%. That way you have enough money to cover some operational expenses and you have less room for error. For example, there are businesses like leasing airplanes to airlines where the margin can be as low as 1.5%. But the sums involved there are so huge and there are so many analysts working, analyzing everything from fuel prices to demand that their results are just stable. So that 1.5% is always there. In an e-commerce business, it's clear that the amounts are much smaller and you don't have those kinds of resources. So the lower your margin, the less room you have for error and the more analysis you need to do. That's why you should always ask yourself, do I really need to work in a low margin business? Because even a small mistake somewhere can cost you. I had a large turnover that ended up with negative margins and I lost all my profit for the past year. That's why you always need to be careful. But targeting a certain percentage, I think, is good for more than half of businesses. So, as I've already mentioned, I don't know if this is relevant for any of you, but often an e-commerce business starts out with dropshipping. So in reality, in that case, well, maybe you can afford not to keep track of your finances. So we bought something somewhere. We're not freezing any assets, right? We invested a bit in advertising. We have a factory that produced everything. We got it all. Everything's great. This is actually a really great way to test a hypothesis, to test the market. I know a lot of guys who basically started out by launching 10 online stores in different niches, and whichever one performed better than the others, they closed the other 9 and went with that 10th one. The one that was the most successful, and then they developed it further. That's actually a good idea too, and a lot of people do it that way. But at some point, when you want to grow, drop shipping just won't work anymore. That is, you'll need your own stock, your own warehouse, and your own products. Why is this important? First, because your profit margins will be much higher compared to drop shipping. At some point, you won't be able to cover new customers. Secondly, you won't be dependent on anyone else. So if the production line of a single factory has an issue, everything you've built over years could collapse in just a week. Third, you won't be able to control quality. That means you'll need to hire more people to monitor quality. They'll have to find new factories for you. In other words, at some point, you'll end up working for someone else. That's why at some point you need to take on additional risk by keeping inventory yourself. This is a necessary step for scaling up. And when you set up inventory, the main task of the vacuum is primarily it's called working on the assortment. There are a lot of different tools for working on the assortment, and we use many different tools in our work, but there is one main tool that actually helps achieve visible results for the business's EBITDA very quickly. This is the so-called associative matrix. That is now, fortunately, across all platforms, we can, in principle, collect quite a lot of statistics about how our products are selling. And we divide them into 4 quadrants. So we have 2 factors. These are velocity, that is sales speed, sales rate, how often they sell, and margin. Products that sell frequently and have high margins are our rock stars. We should definitely highlight them. This could be the top 1% of products, 10 to 15%. It doesn't matter. These are the products for which we should do double facing, meaning placing them in different categories. They can even appear more often on the website. We should build our marketing strategy around them, meaning we should use them to attract people. I even know of one case, this is also one of our acquaintances, where they had 160 SKUs. They picked the top 10, started a new company selling only those top 10 under different brands, and this company eventually generated twice the revenue, less than what the 160 SKUs used to bring in. So people even go for this kind of approach. Also, we work with physical retail as well, meaning we simply place them in different spots in the stores. This is extremely important. If you have high margins and low sales volume, then you simply need to lower the price. And you should always lower the price loudly. In other words, you can't quietly lower the price and not tell anyone about it. If you lower the price, you need to tell everyone so that all people hear about it. And here, it's very important to have a digital footprint. So when you lower the price, that's only 10% of the work. 90% of the work is analyzing that discount. There are different types of ways you can offer a discount. You can simply offer a percentage discount, or you can do something like buy 1 plus 1 equals 3, or even buy 1.5 for the price of 1. In any case, whatever we do, we need to analyze it. On the day we offered the discount, we then compare how our sales performed. Did they increase or decrease? You can compare it to the same month in the previous period, looking at different factors, so that next time we offer a discount, we'll understand that, okay, 15% wasn't enough, so we tried 20%, or on the contrary, maybe it was too much. In other words, any of our discounts should be noticeable and it should leave a mark. If a specific item or product happens to have low profit margins but sells quite a lot, then it's very simple. He raises the prices. And he raises the prices. We do it quietly. So we lower prices loudly, but when we raise prices, we do it quietly, just raise them without telling anyone. If possible, we don't tell anyone about it. If we have a subscription product, I think by law we have to notify the client. So in that case, we quietly let them know. But still, there's no need to announce everywhere that we've raised prices. And again, there should be an obligation for 8 years. We've raised the prices, so we need to understand by what percentage we've increased them, observe how demand and supply react, and possibly make adjustments later. Ideally, of course, prices should be changed at least once every 6 months, and at most, probably once a quarter. There's no need to change them too often either. And you need to change them wisely. Now, there are engines on Amazon and on Shopify too, if I'm not mistaken, that can give you some suggestions themselves. And they actually work really well because they have a lot of data and analyze it excellently. But if we have a multi-platform business, if we have our own website or even a physical retail store, then that's not enough for us. We also need to take a comprehensive approach. I also know many entrepreneurs who say, well, every 6 months we just raise prices by 10% and that's it. Well, we raise prices proportionally to how much our suppliers have raised their prices. That's all great, but it's not right because it means you're not earning as much as you could, or maybe, well, you're under earning, and under earning is the same as a loss. That's why you should always take a comprehensive approach to raising prices. You need to look at your margins, you need to look at your past price increases and how the market reacted. This is called price elasticity. In other words, how elastic is your demand? Say you raise prices by 10%, but if your demand drops by 90%, that's extremely unprofitable. But if you raise prices by 10% and demand stays the same, that's great. So it all depends on the product, on how competitive the products are, and so on. And yes, you always need to look at the market as well. In general, what are competitors doing in similar fields? Are they raising prices or not? And the most difficult situation is this quadrant when your product is, first of all, low margin, and secondly, it's not selling. Here, founders and business owners always have to make a very tough decision. They never want to make it, but sometimes you just have to get rid of it. Sell it at a loss or give it away as a gift. We offer discounts and say, buy 2 high margin products and get this unwanted product for free. You just need to set your goal. We get rid of it within a month. In the first week, we try to sell it at a 50% discount. Someone will buy it. In the second week, we try 75%. And in the third, eventually, we'll just give it away for free. Don't wait for luck. Just get rid of it as quickly as possible. That's all. Because we have to, it's still frozen money and it's dragging us down so much. So we need to free it up as quickly as possible, free up that warehouse space and release some of the money so we can buy something else. And so we need to work with this assortment not only in general analytics when we take the entire assortment and analyze it, but we also need to work with it separately. We need to find rock stars for each brand if we have a multi-brand setup, and for each category if we sell different categories on the site. And then basically that's how it works for us. I had a case where a client came to us. They had an online store and physical stores, and they had 650 SKUs, 100 different brands, and 30 different categories. And right away, they told me, you definitely won't be able to help us. We just have way too much of everything. And I immediately stopped worrying about all the operational expenses. I just started working only with this matrix. And in 3 months, we increased EBITDA by 35%, just by having the right assortment. That's why this is actually a very good tool, and you can make it more complex. For example, there are matrices for products that work as saves. That is, we look at how our products are selling, which product sells better, which one is best. There's a master who studies the product that serves as the entry product, the one through which the client first comes in. But this can bring you significant results very quickly. The second part of critical growth, besides your own inventory, is your operating expenses. Most likely when you grow by 10 million, you need more people because you can no longer handle it yourself. And there's always the temptation, oh, there's the Canadian market. I'll take it on myself. I'll hire someone, a manager for Canada, or now I want to launch a new category. I used to sell supplements there. Now I want to sell drinks as well. So I'll hire a new person just for this one category. And because you set things up and expand there, there's this sense that, yeah, cool, the business is growing. I can hire more people. But here you always have to be very careful because each and every individual you hire, if they're a client, will ultimately bring in additional LCV. A hired employee has their own negative LCV because these are expenses that are multiplied by the number of months they work continuously. If the salary is, say, $2,000 or $3,000, it might not seem critical, but if you multiply that by 12 months, it comes out to $50,000 or $60,000 a year, which already feels less pleasant. That's why every position should always have its own ROI. So, for example, we say we want to enter the Canadian market. We want to hire someone who will be responsible for this, and we need to calculate what turnover is required, at the very least over the course of a year, so that they pay for themselves. And we need to tell them that this will be their KPI, and we need to tie everything to that. And at the same time, you shouldn't even wait a whole year. Already after the first quarter, you should check whether they're meeting their KPI or not. Plus, over the past 2 years, I've started to notice something that wasn't so critical before, but now it's become super critical. It really eats into our EBITDA. Different subscriptions for various software, and especially for different AI tools. There are so many of them now. Every day, hundreds of new ones appear, and there are some cool tools out there that solve specific problems, like increasing your email marketing conversion, analyzing prices better, or responding to clients faster. Everything's great, but in the end, it turns into a situation where a business has 10 to 15 subscriptions, plus a CRM, plus some kind of ERP system, inventory, and so on. These 15 subscriptions cost $60,000 a year in the end. And that's all of its extra profit. So it turns out we increased our turnover from 1 million to 3, but our EBITDA stayed the same. But at least we managed to tweak a few extra features. This, well, it's probably better to avoid this too, and you really need to keep a close eye on it, even though the temptation is huge. Even for us, in this business, honestly, we always struggle with this temptation because so many cool things come up and we say, oh, let's buy this and this and that. But again, you always have to look at what the economic benefit is. That's why you always have to look at this. If we look at our growth from the unit economics perspective, after that, the soma, meaning what we have left over, after all the expenses for Tava, then in fact our main goal is of course to look at EBITDA. So after operating expenses, we need to see that yes, that's it. We're growing from 1 million to 10 million. Everything's great. But our EBITDA is also growing. And the sum, so to speak, well, probably that should also be a good indicator. If you want to reach, say, 10 million, what should you have? It's just that this is a financial model and everyone interprets it in their own way, and probably everyone is right. But this is P&L, meaning the profit and loss statement. This is the balance sheet, and this is cash flow. These are the money flows. All of this must be included because each of these reports answers different questions. And without answers to these questions, you are living with significant risk. There must be inventory planning, meaning you need to understand how much product you should have for each month. This is especially true for a large part of the e-commerce business, which operates actively for only 2 months a year. That's November and December. They can account for 50% of the entire turnover. And very often you need to start planning in June or July to order everything in advance. And here, yes, you also need to be careful. You can't order too much because you'll tie up a lot of funds. But if you order too little, you won't earn enough. At larger scales, well, actually, once you're at 10 million, there are people building data science models in Python that analyze a lot of factors to determine, and this is the necessary order quantity. Well, maybe not everyone does this. It's already quite complicated, but in any case, you need to pay attention to it in order to properly plan your inventory. You absolutely must plan your cash flow. At the very least, there's a tool called the 13-week forecast. That is, you always need to make sure you won't have a cash gap. That's it. I'm completely calm. Everything is fine. I can afford it right now. To freeze money in marketing, advertising, inventory, the website, or anything else, or not. So you always need to keep an eye on this. In other words, you should have a system where whenever you receive any offer or see any opportunity, you first evaluate it through your cash flow. That is, can I take the risk and seize this opportunity right now? Or is that too high a risk for me? The same goes for marketing forecasts. They need to be tied to unit economics. That is, what is our marketing budget? What is our cost of acquisition? How quickly do we achieve the LTV over cost of acquisition ratio? What is the payback period for each client? All of this needs to be analyzed. In addition, we need to make sure that each of our products has a positive margin.